Well, now we know that to a certain extent, trying to make the donkey and breakout system or the turtle-based system to work, we need very large pockets and we need to be very clear about our position sizing and money management in order to make it to work. However, as it is such a popular and well-known methodology, I'm going to try and make some attempts to actually make this donkey and breakout system work better. And when I think about the turtle system and how they used quite unsophisticated methods of getting out of a position, it tells me that really, as technical analysis has moved on, it should be possible to take those original entry rules and build something that's going to work a little bit better. Here we can see on the chart, which is dollar Canada, there's various down arrows that are marked, and we can see that it's not necessarily marking every single bar that we make a new 20 bar low or 20 bar high. The reason for this is that I've asked that the previous pattern before we actually break out of a 20 bar high or low is meeting certain criteria. The code looks a little bit complicated, but in fact all it's really saying is that when we make a breakout, the previous, at least previous 2 bars, the breakout level has either been flat or has been in the opposite direction to the breakout itself. And also the fact that when we are making a new closing high, it's doing so on a 3 bar basis. So it's doing high level -1, high level -2, and high level -3. What this means, if we were to say look at this particular area here, is that the level has to be flat or going in the opposite direction before we do actually make that closing price. It also means that we're not pyramiding every time we make a new 20 bar low. Although if we go flat and then break down again, then we do have the possibility to have some pyramiding. Obviously what this does is instead of just entering a position very early in the breakout based on average true ranges, we don't know the exact number of pyramids that we may get. It could be nothing, or in a more steadier trend where it does have some corrections to that trend, then we still have the opportunity to get some pyramids. Here I've taken exactly the same principle on eBay, and we can see through quite a long trend that lasted 4 or 5 months, there was various instances where we could have added to the position, and then we can see in a sharp downtrend, we can see that we spotted the breakout back down and had a very, very sharp fall. Now you can see that on both of those charts that I just showed you that we had a study on here that was called CON-CNT, and then I had another one called CON-CNT number 2. And what these are a study that tries to identify periods of sideways and counts the number of bars associated with that sideways and gives us some idea of whether we can quantify breakouts based on that point. The first one, if I come in and modify it, is looking back over the last 100 bars, and then in this particular instance is looking at the last bar, and what it is doing is counting, in this particular instance here, how many bars that the range of the current bar is touching all the previous ones. And in this particular instance where we have this spike, on that particular bar, the range of that bar is touching, in one way or another, 23 of the previous bars. What this does is 2 things. It identifies the fact that normally that bar that is touching all of the last 23 would have to have some sort of expansion of range that was beyond the normal, and it has that to a certain extent. Or if it doesn't have a very, very large range, it means that price has been in a very tight sideways congestion period. What we can do from that is then say, okay, we don't know what the direction of the breakout is going to be. All we know is that we're in sideways or a period of congestion. And so then what we do is we wait for the breakout to occur and trade in that particular direction. And as we can see here, having been in sideways, we then got a Donchian or turtle-based breakout on the downside, and in this particular instance, we slumped quite alarmingly. Now I've moved back to that dollar Canada chart, and there's two things that stand out here. The first thing is we use the first congestion count period. We can see that in this particular case we have a large expansion of range which is overlapping all of the previous 33 bars. And then as the trend develops, we can see that this second congestion count also starts giving us some signals. This calculation is slightly different in that it's also looking back at 100 bars, but this time it's in a mode called group. And what that means is that when it reaches, in this particular instance, 11, it means that all of the previous bars are all touching each other in terms of range on a consecutive period. On the previous instance, when we're just looking at the last bar, all we're saying is that the last bar is touching the range of all of the previous bars. It doesn't necessarily mean that it's happening consecutively. What this means is that the thresholds for sideways or congestion are different for the two studies. You can see that on the first one I've set the threshold at 20, and on the second one, where things have to happen consecutively, I've set the threshold to 10. So if we look at how the sequence of trades would have developed, we had a congestion that indicated a large piece of sideways, but it was actually some time after before we got a turtle or Donchian base breakout. A few bars on, we can see that now we are touching 11 bars consecutively, and then on the following bar we get another Donchian base breakout. We move along. Here once again we have congested 10 bars in a row, and then we make new lows on that bar. And then finally, at this point here, again we have the symmetry of the congestion and the breakout occurring on the same bar, but this final signal doesn't really work after what was an extended trend that lasted over 6 months, and the trade finished.